As Warren has pointed out in the past, one of the drawbacks that Geico is faced with, it hasn't been doing as good a job as matching rate with risk and segmenting and pricing the product based on the risk characteristics. This has been a disadvantage at Geico for a few years now. We are trying to still play catch up. Technology is something that is unfortunately a bottleneck, but there again, we are making progress. And equally importantly, we have hired people who are much better than what they inherited in terms of data analytics and pricing and slicing data.
Two things I want to talk about in this video. First of all, right here, right now, this is from 2024, Berkshire's annual meeting. Geico's leadership admits they're not as good at slicing pricing based on data. They literally admit that they're not as good as say, Progressive when it comes to underwriting based on data. And if you're an analytical person like me, you know it's pretty important to have underwriting that can be as accurate as possible, because in the long term, that's going to draw you in all the very best, most profitable customers, and then leave for the rest of the market the worst, most dangerous customers. So it's really amazing to see Geico, one of the insurance leaders, literally admit they're not that great at matching risk to price.
I would add that equating rate with risk obviously is important in every line of insurance business. I mean, that's what you're involved with is deciding whether a given rate offers us the chance or the probability that we will make a little money on it, and that sometimes we're only risking losing a little, and sometimes we're risking losing huge amounts. But Geico and Progressive has done a better job in that recently.
And we can thank Warren again for just pounding home this first point, that matching rate to risk is a really, really big deal in insurance. And Geico literally admits they're not as good as Progressive at this. And the market has rewarded Progressive because of this over the last number of decades. Even just in the last 10 years, Progressive stock has done a 10x return. But for Lemonade's sake, their use of telematics in their own car product, as well as their ever-advancing LTV to CAC models that covers not just car, but their entire spectrum of products and how they market those products, I believe Lemonade is going to be a Progressive 2.0 or 3.0 type story where they have the best rating of risk to reward in the marketplace. But this all leads us into the second point of this video, where Warren explains the advantage that he still sees Geico having, at least for now.
But our fundamental advantage at Geico, of course, is that we have lower costs than virtually anybody, and that cost advantage has been dramatic. We've driven our underwriting expense ratio below 10%, and there's just very, very, very few companies that can compete with that. So
the second point of this video, and the point that Warren's making, is that even though Geico is not as good as underwriting, he says their operating efficiency, their overhead is better than anyone. And he basically says, yeah, we're not so great at rating risk to reward, and that's really important, and we're not as good as, say, Progressive at that, but at least we're still more efficient than anybody. We still have the lowest expense ratio and are the most operationally efficient. But switching back to Lemonade, I actually think this is where we as investors can have the most certainty that Lemonade is going to have a strong advantage. It's more a question of what is the scale and magnitude of that advantage as Lemonade grows in size.
Let's take another look at our IFP numbers compared to our headcount numbers. Our IFP has grown 25% year over year in the last 3 years. This represents more than doubling our business. At the same time frame, our headcount has only grown 2%. One metric that's helpful when you think about efficiency of a company is the ratio between a company's top line and its headcount. Today, Lemonade is just shy of $1 billion in IFP, and that ratio of IFP over headcount for Lemonade is $730,000. As we double our business, which will be more or less when we reach net profitability, we will already rise past most traditional insurers, including the likes of Progressive and Geico, companies who at this point in time will be 20 times our size, but less efficient. These companies tend to get confined and stuck in this efficiency zone, as their ability to scale effectively diminishes over time. But you know what? This isn't our peer group. We're aiming higher. As we double our business again, with really conservative assumptions regarding any future efficiency gains, we expect to be still smaller, but more efficient than some of the best companies in technology. And we continue down that $10 billion path that Maya just described to you. At this point, our headcount numbers are perhaps more speculative and vague, but the principle still holds. We expect every employee at Lemonade to make $4 million in IFP.
So as Adina lays out so well, Lemonade's going to go from $730,000 IFP for employee all the way up to $4 million per employee. And I want to just showcase why this would be absolutely insane. They would wreck the insurance market and the competition, or even if they do half as well as that, maybe they get to 2 million IFP per employee. So this is where they've been at historically. Back when they were really just one product, they were at 375,000. Actually got slightly worse as they were trying to expand and build new products and roll out things, that as those products have climbed, their headcount has stayed steady. They went from 300-some thousand per employee all the way up to 700,000, a steady rise, and we expect this to continue to rise, just like Adina showed, where I'll go from that 700,000 all the way up to the 4 million. And I put a post on X about this, or on Twitter. It said Lemonades, they have 1,260 employees now for 730,000. If they go to 10 billion at 4 million per employee, that's 250 or 2,500 employees. So roughly from 1,200 to 2,500 as the premium goes from less than $1 billion to 10 billion. So 10x plus in IFP, while roughly 2xing their employee count. And Brian at BJM Tweets on Twitter, he's a great follow for Lemonade content, created this really, really excellent graph that shows IFP per employee from Lemonade right now, 730,000. They're planning to go probably in the next 8-9 years, whatever, 7 to 10 years probably, as they go from $1 billion IFP to 10 billion IFP. They're planning that they can make it to something like 4 million IFP per employee. And he pulled the numbers here for USAA, Allstate, Progressive, and Geico. And you can see, just like Warren Buffett was saying earlier in the video, Geico's advantage is that they are operationally efficient. I don't know exactly the scale, but looks like they're a little bit above that $1 million of IFP per employee. But Lemonade's, they're trying to 400% improve on who the already leader of the pack, Geico. You can only imagine how incredibly good Lemonade's expense ratio could become. It's absolutely wild to think. And of course, this is if they get to 4 million. Maybe you're skeptical and you think they get to 3 million, 2 million, whatever the case is. Even if they're at 2 million, they're still going to absolutely thump and wreck the competition. And the same sort of visual, that graph that Brian had, you can see all the main insurers, Progressive, Geico, Allstate, Travelers, all around this range, while Lemonade is planning to jump way ahead of them, even ahead of companies like Spotify and Netflix, because they've built the company on this digital foundation. They've built these models that can handle claims, can handle customer requests instantaneously, can sell products instantaneously to customers with no human interaction. That's how you can sort of have this quote unquote infinite scale that they're talking about. And that's the crazy thing I just want to stress to you, is that Warren Buffett himself is saying, hey, Geico, we have this data disadvantage. We're not as fine-tuned. We don't have the same data analytics as Progressive. We're getting better, but even if we're not perfect or never quite as good, we still have this advantage of our cost structure that we can do things a really lean, scrappy way. But for Lemonade, if that's the only advantage that Geico has, and Lemonade's going to leapfrog them, going to 2 million, 3 million, 4 million IFP per employee, they're going to be drastically more efficient than Geico at their own game. Plus, like I said earlier in the video, the first point, I think Lemonade is going to be better than Progressive. They're going to be the Progressive 2.0, 3.0 in terms of matching risk to rate and using data to do that. So Lemonade, in my mind, is the best of both these worlds. I think they're going to show the market over the next few years that they have the best underwriting and data collection, data use to do that. And then they're also going to be the most operationally efficient. So you're not just getting the Geico 2.0, you're not just getting the Progressive 2.0, you're getting the combination, which is like the Lemonade 5.0 of both of those. It's going to be absolutely wild. I can't wait to see it. Thank you so much for watching. Remember, it's in the bag.